Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Jarrod Kerr, who's Chief Economist at Kiwibank. And we're here to do basically a negative official cash rate, or OCR 101, talking through what a negative OCR might mean if indeed we do get one, as indications seem to be that we may well do next year. So first of all, Jarrod, welcome to interest.co.nz again. Good to see you. Now, I guess let's make it really basic here and say, start off with the OCR. So what is the OCR and why does the OCR matter?
So the OCR is set by the central bank, and it's an overnight rate which the banks deal with the central bank. The central bank is the banker of the banks. But basically the OCR sets the term structure, the starting point for just about all interest rates in the economy. So most interest rates are set off the OCR or at least expectations of where the OCR is going to be. So when the central bank cuts interest rates, you'll notice that most interest rates in the economy fall along with it.
Obviously, the OCR is currently at 0.25%, which is a record low. There's growing talk now with the COVID crisis continuing and likely to continue for some time yet, that the OCR could go into negative territory, that is below zero next year. What would that actually mean?
Yeah, it's a good point, and it's something which central banks and academics have been discussing for over a decade now, as we've seen other central banks around the world take their cash rates below zero, down to sort of minus 50 basis points or around there. What that means is clearly all interest rates keep falling. And the theory is that you keep cutting interest rates lower and lower, and that forces people to do a little bit more with their money rather than just keeping it in cash or tied up in bonds. You're trying to push people into riskier assets. You're trying to push people to do more with their money and hopefully stimulate economic activity.
The why of it then is, I guess, to try and stimulate that economic activity, and so the Reserve Bank can try and meet its inflation and employment targets. Is that the why?
Yeah, absolutely. We're in a situation now where our unemployment rate is rising or looks likely to rise quite substantially from here. Inflation is below target and it's likely to fall towards zero. So as a central bank, you're looking at your dual mandate and both of them are moving away from you. So in order to try and get them back to target, you need to do more. Obviously, we want the government to do some of the heavy lifting, if not most of the heavy lifting. But as a central bank, you also have to come in and do what you can. And they've already cut the cash rate. They've already started a quantitative easing program. There's a lot more they can do with bank lending, but of course, a negative cash rate is also an option.
If we do get a negative OCR next year, which a lot of people now seem to think we will, what impact might this have on, I guess, firstly, mortgage rates, but also personal lending rates and business lending rates?
So firstly, all retail rates, rates faced by mums and dads and businesses will stay positive. So a term deposit rate above, yeah, exactly, stay above zero. So we could have a cash rate of minus 50, but banks will still keep their deposit rates positive, but obviously not at the rates that they're at today. They'll be cut, and all mortgage rates and business rates will also fall in that environment, and that's the stimulus that you want. The question marks around other wholesale rates going negative is the issue, and that's where you'll see the government bond curve. Most of the government bond curve would trade negative, which is extraordinary. So basically, the government could issue a bond, an IOU, for $100, and then only pay $98 back because of that negative interest rate.
But so I guess the key message for people with mortgages, people who put deposits in banks is the deposit rates. You would not anticipate, I don't think any economists anticipate that retail deposit rates would fall below zero, and mortgage rates would fall from current levels, but they'd also be above zero.
Yes, exactly. I think you'd have to go deeply negative, you know, to sort of -1, -2%, which hasn't been tried yet, in order to really force that issue. And the central bank has been quite clear that they don't want retail rates to go negative, but they do want them to be closer to zero than they are now.
You mentioned government bonds before. What about the New Zealand dollar? What might a negative OCR, what impact might a negative OCR have on the New Zealand dollar?
Well, it would have, I think, quite a big impact, because we would be doing it at a time where other central banks aren't, and other central banks like the Fed, the US Fed that is, and the Australian central bank, the RBA, have both shied away from going into negative territory. So we would be doing something somewhat radical compared to some of our peers. And when you're looking at a currency, it's basically, what are we doing versus what are they doing? And if we're going into negative territory, that would put pretty big signal to international investors, maybe not put your money into Kiwi dollars, and you would see the New Zealand dollar fall, I think, quite substantially, like into the 50s.
But for the lenders, I mean, the banks, I guess also the smaller lenders, building societies, credit unions, even finance companies, what impact would a negative OCR have on them?
So the international evidence is reasonably clear that as you go into negative territory, there is quite an impact on profitability within the financial system. So as banks, you know, we hold a lot of capital, and that capital earns an interest rate. All of a sudden, some of that capital would be, you know, having a tax on it effectively. So the accumulation of capital, and don't forget, we are being asked to hold more capital over the next 5 years. The holding and accumulating of that capital becomes harder in a negative rate environment. Our net interest margins decline, so profitability of banks comes into declines, and that again makes it harder to accumulate more capital. But it's not just the banks that face reduced profitability and issues with negative rates. It's also fund managers and insurance companies who are trying to hold assets and grow a pool of assets to meet future liabilities. So we're trying to save today for our retirement tomorrow. What it actually means in a negative rate world is that you have to save a lot harder to get to your endpoint. And as an insurer, you're taking premiums in today to pay for future claims. You're going to have to, you know, do a lot more today to meet those future claims. So it puts stresses throughout the financial markets, and the evidence overseas is debatable at best as to how effective negative rates are.
Yeah, that was my next question, actually, looking at the learnings from overseas, because obviously quite a few countries around the world have had negative rates over the past decade. So what would you, in your view, would be the key learnings from overseas experience with negative interest rates?
Well, negative interest rates definitely lower interest rates throughout the economy, and that is helpful. But the stresses that it puts on the banking system and also the allocation of funds within fund managers and insurance companies is a problem. And the longer term risks associated with that are, you know, still being analysed, I guess. So there is a bit of a polarised debate out there. There's a body of research that says negative rates are not effective and should not be done, and there's another body of research that says, well, yeah, they are effective, and probably they'd be more effective if you go deeply negative and, you know, apply it to retail rates as well. And I don't think we want to go down that path.
That again leads me on nicely to the next question, because I'm just wondering, how negative could we go? You know, I mean, most of the talk initially in New Zealand is OCR negative 25, 50, maybe 75 basis points. Could it go beyond that? And what would happen if it did?
It's a great question. I mean, when I went to school, we couldn't go negative. That just wouldn't happen. It would mean that people would rip their money out of the banks. They would stuff the cash in their mattresses, and you'd see what we actually saw happening in Japan. But here we are, and it seems like people are actually willing to still hold money in the banks, even at very, very low rates and even slightly negative. And it looks like the theory is saying, well, we've gone to -50, maybe we could go to -1 without breaking things too badly. So the theory is just that it evolves over time. You figure it out as you go. But the research that we've seen out there from the serious central banks around the world suggests, around that -75 to -1% seems to be the lower bound for now. But bear in mind, they said the lower bound was -50 and 0 not that long ago. So we're still feeling our way through.
Absolutely. Now, the Reserve Bank is talking about also introducing a funding for lending program, potentially alongside negative OCR. What do they mean by a funding for lending program?
Look, I think this is the best policy, and I think this is the one part of their next move that I agree with the most. And I think that what we've seen overseas in Australia, Europe, and other parts of the world is that when the central bank provides effectively a lending facility to banks to say, hey, we know you're mostly funded by retail deposits and you've got some wholesale and you've got some other bits and pieces of funding. Here is a very cheap, or the cheapest source of funding for you to go out and then lend some more. So we could actually get a lending facility set up with the central bank off the current cash rate of 25 basis points. So we would get funding at a very, very cheap rate of around 25 basis points. We then take that funding, and they would only give it to us if we take that funding and then lend it out. And that would enable us to reduce mortgage rates and business lending rates, because we've been given access to a source of funding at such a cheap rate, and we're not fighting for retail deposits. So the bank funding mix would change in everyone's favour. The only downside I could see to that is that you would have a dependence growing on such a facility over time, and you would want to probably unwind that at some stage. But that's a nice problem to have, not a risk, I don't think.
So, Jarrod, typically when the Reserve Bank moves the official cash rate, whether it's up or down, it's by increments of 25 basis points. Is there any reason why they can't move it, say, down from 25 to 20, 15, 10, or even 5 or 2 basis points before going 0?
Yeah, they can. They can do what they like, basically. But it's the message that sends to the market. So cutting 10 basis points from here, what's that really going to achieve? You might actually look probably a little weak or shy, and that's not going to help drive down mortgage rates. So I think if they were going to make a move from here, they could cut 25 to 0 just to get that initial move underway, and I think that accompanied by bank lending would be very effective. But it seems like if they're going to go negative, they'll go there in one move. So you could actually see a 75 basis point cut from here, from plus 25 to minus 50. It's a strange thing to say, but that's what we could see early next year.
Quite something. Now, obviously, we've got quantitative easing going on already from the Reserve Bank, with them buying government bonds, local government bonds. They're saying now up to $100 billion worth by June 2022. If we do then go into negative rates as well, I guess a question around that is, how do we get out of that? How do we get out of QE? How do we get out of negative rates? Because it has been challenging for other central banks and economies over the last decade to do that, hasn't it?
Yes, and I think the most challenging part of this is the performance of the economy. You kind of hope that once you've thrown everything at it, including the kitchen sink, that you get some growth and inflation down the track. So I think if we wake up in 5 years' time and our economy is growing at a decent sort of 2.5–3% clip, and our inflation rate's running at something similar, it would be much easier to unwind these programs. I mean, the quantitative easing, the central bank just evaporates that. You just stop buying government bonds and you let those bonds roll off, and all of a sudden that program unwinds, moving out of negative. Well, you've seen the Riksbank in Europe, cut into negative, and then once they had a little bit of growth and inflation, they hiked back to zero. So it is just simply a case of moving that OCR at a time when you're comfortable that your economy can handle some tightening in financial conditions.
Could it be a new normal, negative interest rates?
Well, unfortunately, yes. We've done quite a bit of work on demographics and how demographics have influenced interest rates over the last 40 years. And as we have an aging population, you have a larger proportion of savers. There has been a global savings glut over the last few decades, and that has put downward pressure on interest rates. But you've also got a smaller proportion of your economy willing to go out there and take on debt and have a crack. So that's also put a reduced demand for money or credit, I should say, and therefore the price of credit has fallen. So our simple modelling, based on how New Zealand's population evolves over the next 40 years, shows that the pressure on interest rates continues to be down, and we may actually see negative rates become the norm.
Just finally to wrap up, Jarrod, I'll ask you, what do you think the Reserve Bank will do from here? And then what do you think it should do from here? Put you on the spot.
Well, yeah, exactly. Look, I think they should take a two-step approach. They should do the bank lending facility first. They should give that a go and see how that influences interest rates. And I do think that would provide meaningful stimulus. And then I think they could test the waters with negative rates if we need it down the track. But what I think they will do is, basically what they are telling us is they want to do this in one move. So if the economy needs it, they will cut to negative at the same time as providing bank funding. So yes, we could see that in the first half of next year.
Great. Look, thanks for that, Jarrod. That's really useful. That's Jarrod Kerr, Chief Economist at Kiwibank, and I'm Gareth Vaughan at interest.co.nz.